Hi, you're with Property Mythbusters, and we're here to debunk myths within the property investing space. I'm Ken from Avvora Finance.
I'm Debra from the Property Frontline.
And I'm Gilmovich from Real Property Manager.
Perfect. And so today we're just talking about giving you a quick update in the property market space and what's happening out there, given everything that's playing itself out. Deb, what's happening in the buying space?
Well, I've actually got some graphs today, so let me just share my screen and I'll give you a bit of an update. So what we're looking at the moment is a graph showing the change in search rates as reported by realestate.com. So you can see here they've experienced the biggest jump in their history of a percentage change in the number of people who are searching. So that tells me that there is a lot of interest in the market, and it coincides with what I'm seeing when I'm talking to my clients. So there's more people who are still keen to buy. Of course, there's a couple of things we need to talk about in relation to that. And so this one was the residential graph. This graph I'm showing you now is for commercial property. Now, they actually had a much bigger drop. So this is the 1st of March, and then by the 1st of April, they experienced a 40% drop in commercial searches, but that, of course, has recovered as well. So these are stats as at the 11th of May, so Monday.
Yeah, that's a classic V curve right there.
Yeah, that's right. But that's just one indicator. Then this is a clip from last Saturday's paper, where we can see, whether that you could argue that the newspaper turned up and actually, got snips of a really active auction, but really that's what I'm seeing when I'm out on the ground. From a stats perspective, these are the auction clearance rates as of Monday. Actually, that's Monday the 11th, sorry. I will just change that. We want to be factually correct here. And so, yeah, this is from CoreLogic. So they're saying that the clearance rate, so successful auctions, 70% in Sydney, and you can see the following numbers. Melbourne's interesting because they were still fully in lockdown. So Sydney last weekend was our first live auctions and normal opens, so group opens. But of course, the thing to be cautious about is these numbers are very, very low. And so I don't really think they're a good indication, because the numbers are so low, they're not really, sort of not a good representation of the true impact of what's happening in the market. But the next thing I wanted to show you just very quickly, because I think this is a true indication of what I'm seeing in the market and what we're seeing from a data perspective. And so the story here is, this is a little renovator type of property. So Tempe, for those who don't know, is very close into the city. It's under the flight path, but still a very coveted area. But it's a real renovator, and people have paid.
Wow, look at that wallpaper! Amazing.
Yeah, but it sold on Monday for 950,000, which is way too much. So I would have paid in March maybe 800 for this. And so this property has been in the hands of a very good agent who has talked the property up. And so a lot of buyers are thinking, oh, I'm in a buyer's market, so I'm getting bargains, but actually they're not. So that's me. But in summary, really, we're seeing the market reactivate, and just got to be smart. Do you
think that's this strong sort of result is attributed to the fact that less properties are actually on the market right now, Deb?
Yes, that is another factor. And yeah,
especially established homes.
Well, yeah, we're still seeing that the 2-speed market, which is where we'll see those bigger drops. But yeah, okay, so that's me.
Good stuff. So let's have a look at the rental market. Last time we were live, we had the past 3 months statistics, which on this occasion we've got refreshed stats here from SQM Research as to what's occurred in the last couple of months in the rental market, and there's been some real dramatic changes on that front. And the obvious one to me, if we're looking at the listing numbers, so what you see in front of you are the Sydney Metro, Melbourne Metro, Brisbane Metro, etc. The actual listings are growing pretty quickly. So as we can see, the stock levels are an all-time high, because about this time last year, we were hovering in Sydney alone at around about 19,000 listings. And now we're heading towards 30,000 rental listings that are currently being advertised in the Sydney metro area. Now, you can see that obviously the trend is tenants vacating properties and potentially moving back home to save money. Some of them have lost their jobs, have had pretty substantial reductions in incomes, whereby some of the rents they've been paying in the last few years are just not sustainable anymore. So that's leaving a massive glut of properties that are now available. On top of that, you've got all the short-term rental listings that have also come back because simply they're not able to be let, given that our borders are closed, there's no tourism, no one really coming into the country, students, short-term, visa workers, those coming in usually on, short-term projects are no longer coming into the cities. So all those short-term corporate lettings, Airbnb lettings are now coming back onto the permanent market, and that's increased the stock levels even further. So just at the top right-hand side, we can see going towards 4% vacancy rate.
Is this what you mean, John?
Right there. Thanks, Deb, for circling that. And as a rule of thumb, 3% vacancy rate is where supply equals demand, and we're tipped over. We're over that now, so we're actually in excess supply, where supply is exceeding demand. So what does that mean? Well, that's a lot of pressure on rents to fall, and they are falling. It's very clear. Listing prices for rentals have fallen somewhere at the moment in the vicinity of 10 to 15%, and especially the strata apartment market, where generally there is an oversupply. The homes, the established homes, the houses, the semis and the townhouses are generally holding, but in some cases they're not. So dependent on locations. For example, those around in the west, on the fringes of the city, Surrey, places like Surrey Hills, Balmain and so forth are experiencing some pressure as well, given the fact that a lot of the occupants there were commuting to the city and were working from the CBD, but now they're not. They're working from home. A lot of the businesses that are city-based are no longer operating, so it kind of makes the proposition very difficult, especially with corporate leases paying all of these big rents. Have had to cut and let go of these properties because they're no longer necessary.
Okay.
And in particular, if we look at that 2000 postcode,
we'll have to be careful because we're now running out of time. But
yeah, so just to point out, have a look at the 2000 postcode. So that's the CBD itself, with a massive, unprecedented vacancy rate of property, heading towards 14% vacancy, and that is a huge problem for CBD investors.
Historic. Okay, thanks, John. So, Ken, are you able to give us a bit of an update from your perspective?
Yeah, sure. Quick update in terms of what lenders are doing. So it's taken a while, I think, for them to work through whatever it is that they need to kind of keep home loan applications being assessed. There are a lot of logistics in terms of verification of identity, given social distancing and people not meeting face to face. It's just interesting how that's kind of played out. But the credit policy side of stuff, has increased as well. I know that at this time the restrictions are lifting, but the credit policies are mainly focused on income. So I think previously I did mention that your variable kind of income, such as your bonuses, commissions, overtimes, things like that, they seem to be getting a bit more of a haircut than what they were. So they won't use 100% of it. Sometimes they were never using 100% of it, but they're being a little bit more cautious there. So the focus is generally income, making sure that you're still receiving that kind of income. For people who are employed, PAYG, you probably need to provide more recent pay slips, which probably isn't too much of a drama. Sometimes they do want to see actual bank statements showing their salary credits into there. And so last time it used to be like 60 days time frame. Now they've tightened it up to 30 days or the absolute most recent pay slips. For self-employed, generally you could previously you could get away with just providing tax returns, but now they're also wanting BAS statements just to make sure that the flow of income is coming through and the currency of that income is still validated.
Yeah.
So the only other thing that I'd probably mention, there are, and each lender's managing their own risk in this regard, but there have been some tweaks to rental income. Previously, you could they do a flat 80%, 70%. One of the major lenders are kind of tweaking that a little bit, saying they'll either take 70% of the rental income, or they'll use or include your expenses, and whichever one's lower, they'll kind of use net. The other thing as well is the LVRs. A handful of lenders have adjusted their LVRs. Maximum lending for say investment and interest only is 80%. And there was also another lender who previously, for owner-occupied first home buyers, possibly wanting to borrow 95% LVR plus lender's mortgage insurance, have kind of revised that to just 90% capped within that. So there are changes. It is a little bit harder, but basically, if financial position hasn't changed that much, you're still receiving that income, and it's not a variable kind of income. You're still able to. There's a stronger chance for an approval, or you're less likely to be affected, should I say, by the changes. So that's just something to keep in mind.
Okay.
So that's.
Sounds good. Alrighty. Well, thank you very much for watching.
Thanks, Peace, for joining us on this current market update with Property Mythbusters. If you would like to reach out to us, you can either reach us out on this channel or our respective social media channels. But until next time, hope you're doing well.
Okay. Bye-bye.